Good afternoon, Panicos. It's a great pleasure to have you in SOAS and present in this really important conference on fintech as well as on inclusive finance. It was a very inspirational speech. So we, for our audience, we would like to ask you more questions. First of all, would you tell us a bit more about yourself, your research, and also maybe the institutions you are working in or you worked before?
Oh, yes, of course.
Please.
Yes. I'm Panicos Demetriades. I'm a professor of financial economics at the University of Leicester. I've been at the University of Leicester since 2000, so about 19 years. But I took a couple of years out when I was governor of the Central Bank of Cyprus in 2012 to 14. A period which was very turbulent, not just for Cyprus, but for the euro. So I had to manage a massive financial crisis during those 2 years.
Indeed.
So that's part of my sort of work experience, if you like. So I do a lot of teaching and research on financial inclusion, financial development, financial stability, monetary policy, but also I have some policy experience and written a couple of books about that policy experience.
So, would you like to tell us any particular, go into a little bit detail about the research that you are doing right now?
Yeah, the research that I presented at this particular conference was on African financial development and financial inclusion. And one of the problems with sub-Saharan Africa is that there's been a lot of research about whether banks and bank credit is helping to promote economic activity, economic growth. And in fact, I've done some of that research myself. And in 2011, I had a paper in Economics Letters in which we showed that in sub-Saharan Africa, although there is a strong relationship between financial development and growth, it's the causality is mainly from growth to financial development. So it's financial development basically following growth rather than leading growth.
Right.
So we wanted to look more into that. So that earlier research used sort of macroeconomic measures of growth, the GDP growth rate.
Yeah.
So what we did now was to follow a slightly different channel and, of course, slightly different data. And the channel that we are looking into, the paper that we presented today, is entrepreneurship.
Yeah.
And by that I mean is formation of new companies, registration of new companies. There's a World Bank data set that has that data. And we look to see whether financial development as measured by private credit by the banking system to companies helps to promote entrepreneurship, new firm registration. And what we find is that although in other parts of the world this doesn't seem to work very well, in sub-Saharan Africa, actually it is valid and it's very robust and significant. So it is an important result, I think. It shows that actually there is a channel of growth that the banking system, the financial system in Africa can help with. There is, however, a proviso. There's always a proviso. And that is that when the banking system is granting out this credit, it shouldn't increase its own fragility. And
Indeed.
what do I mean by that? I mean non-performing loans.
No.
And that's been a problem in Africa.
Yes.
I have some other research which shows that banks don't want to lend because a lot of the loans go bad and they become basically very risk averse and decide not to lend.
Indeed.
Right?
Yeah.
So the proviso here is that, yes, you can actually increase new firms, new entrepreneurship, which is great for the economy because it means that competitiveness, innovation can be enhanced
Indeed.
through the new entrepreneurs. But proviso is you've got to basically make sure that loan quality, the portfolios of banks, do not deteriorate.
No.
And that's pretty important condition, basically. You've got to do good quality lending. So that doesn't get you into trouble afterwards, because we know what happens if you get a crisis if you get excessive financial fragility and
Yeah.
financial crisis are not good for growth at all,
Not
not
at
good
all.
for financial inclusion. They're bad for poverty, etc.
Yeah, indeed. I think it's very interesting research, and also the results is very interesting in a way that when we talk about, we had a paper talking about SMEs, right? It's difficult for them to have access to finance, precisely because the size of the project and also maybe their credit history makes it look like going to be a problematic loan later on, and the commercial banks are reluctant to lend to them. Microfinance may not have sufficient fund to lend to them. So, but then at the same time, your results show actually being able to borrow, it actually have very important positive impact on their growth and also economic growth.
Yeah.
I think put the two together really inspire us to look further in this area, how best can motivate banks, including commercial banks, to allow better access of finance to those entrepreneurs, especially in the way being sustainable, like you said, rather than later on have actually a negative impact on the banks themselves.
Yeah.
So I think this is it's not just important for Africa, isn't it? It's also important for many other countries, including developed countries, where entrepreneurs constantly facing difficulty of getting finance, isn't it?
It's certainly it's very important for outside Africa as well.
Yeah.
One of the interesting sort of results that we have in the paper is it's a little bit technical, but I'll try and explain it without going into too many technical details. In order to identify these effects, we use what is known as instruments in econometrics.
Yeah.
And our instrument, in this particular case, we think it's a very good one in that it captures financial inclusion.
Oh.
It is gender balance. In fact,
Okay.
so societies in which there is more gender balance, we believe, are more financially inclusive. So that has a positive impact on credit to new companies, we think.
That's interesting.
Right? And we also do some more interactions of that variable with the sort of legal system, right? And we find that in countries in which they have a French civil law, their origin at least.
Yeah.
Gender balance is even more important than in countries with British common law. And
why is that? That's interesting.
We think, and of course that's a conjecture, that the reason is that countries that have a British, based on the English common law system, tend to be more financially developed.
Yes, that's true.
And therefore, financial inclusion is not as big a problem there, and that's why this gender balance variable doesn't help as much, right? While in the countries that have French civil law, they tend to be less financially developed, and that's where it has a bigger impact.
I see.
So if you are a sort of French civil law country and you have more in terms of gender balance, then you're going to get more in terms of financial development, inclusive financial development, and a bigger impact on the creation of new companies.
Yes, indeed, I see. So this origin of law, it's really a proxy for the level of financial development in a way.
Yeah, people have used it in the literature like that. The British common law protects more creditor rights, etc., and is better for development of credit markets in effect.
Indeed.
And we, anecdotally, we can see that creditor protection tends to be better. It's not. I mean, it's obviously origin is important, but the development and evolution also matters. I have some other work on India, for example, that was published a few years ago, that shows, done with lawyers, right, where we measured creditor protection and various legal reforms, and those legal reforms actually are kind of important for strengthening creditor rights, but also strengthening the functioning of credit markets. right? So credit markets obviously do depend on the legal framework
Very
in
much
which they're
so.
embedded, and when the legal framework is not doesn't protect creditors' rights, you get either reluctance of the banks to lend, or you get crisis, which, as I mentioned, is bad.
Indeed, yeah.
We have, for example, in Europe, go to Europe now, cover other parts of the world, in Greece and in Cyprus, where I'm coming from. Greece has a French legal system. It's got the worst non-performing loan ratios in Europe. Cyprus used to be the worst, and in fact, Cyprus is on British common law. But when it comes to protection of the creditors, it's although it's there, it's there's so many impediments into the implementation of the law that it would take like 10 years for a bank to foreclose. So that means essentially that encourages people to default.
Yes, yeah.
That encourages strategic default.
So there's not much of a protection or hope for those people lend money to them, right?
Yeah. And that's partly why we got the crisis in 2013 in Cyprus, which is something I wrote about. I wrote a book on that.
Be very interesting to know. So what was the key findings with your experience in Cyprus or your work on crisis? Say if you summarize it as one key thing you would like to share, what would be the key thing we look out for?
Yeah, it's a very good question. Thank you for asking it. So if I want to identify one single factor of what could prevent crisis, right? What sort of governance, variable or governance sort of metric?
Yep.
Is the independence of central banks or the independence of regulators, right? And I felt that the independence of the central banks, even in the euro system, cannot be taken for granted. In fact, I have a new book on central bank independence coming out next month.
We have to look out for that.
And I think that inevitably, in a system where you have a lot of obviously borrowers and lenders, and you can't think outside the politics of it, the political economy, right? And that's why I like SOAS so much, because there is a lot of political economy here, right? People understand that political economy is part of the financial system. You can't just see things outside that.
No.
And if the regulators are not independent from the politicians, then things can deteriorate very rapidly because the pressures on them are just to turn a blind eye, to sort of carry out forbearance, right? And it's a lot harder to do the right thing.
Yeah.
So a central bank that is independent is the central bank that can say no to politicians. A good central bank, as the economist said many years ago, is one that can say no to politicians. If they can't say no to politicians, then it's inevitable sooner or later things will go wrong, and you might get a crisis.
Yeah.
So that's why it's important to strengthen central bank independence. But with that, you obviously have to have accountability.
Indeed.
And legitimacy, and that's it goes hand in hand.
Indeed.
So the central bank has to be accountable not just to the parliament but also to the people of the country. So they've got to be explaining what they're doing clearly, transparently, and so that even the public understands it.
And do we have we're talking about a different type of law, whether it's a common law or civil law. So from that point of view, do you think different type of law or origin of law give us different environment for such independence of the central bank governor?
Well, that's an interesting question, something perhaps that is worth sort of looking into. But clearly, I think central bank independence is important, whatever the kind of legal system that you have.
Yes.
I don't see that it's less relevant for a common law system or less relevant for a civil law system. I think it is
equally important.
It is equally important.
Yeah.
I haven't seen any results to suggest that it would be less important in some legal systems.
Yeah.
But clearly, obviously, avoiding crisis, having a stable financial system, a healthy financial system means you need to have a good regulator. Often it's the central bank, not always. It's not always, but whoever it is, they need to be independent from the political pressures, and then the legal reforms that are put in place are the legal reforms that are necessary for the functioning of the credit markets. And going back to Africa, if we may go back, one of the problems of Africa is that the credit markets have not been functioning very well, and because of the high non-performing loans, the banks have been very cautious to lend to businesses, to SMEs.
I see. I think that's what I mean. We, in some way, we do need probably legal frame to support or to enhance the independence role of the central banker, the central bank governor. So I was thinking maybe with different type of loan, this legal frame would be slightly different. So I guess the bottom of the question is rather where or what ensure the independence of the central bank?
Yeah, that's a very good question. So what ensures the independence of the central bank? Well, you can talk about the law and the legal framework and the governance of the central bank, and obviously every country has its own central bank law, and you know, it starts from there, right? So if the law is clear, transparent, and explains that what independence means, because what does independent mean? It means generally it means that you don't take instructions from government or any other body. You don't seek to take instructions, but it's a two-way process also, that they don't try to interfere. They don't try to give you instructions, the government or whichever body. So that's sort of a definition. A clear mandate. What exactly is it that you're doing? Price stability, financial stability, what is it? How do you rank the two, right? So the mandate of a central bank is absolutely important. Accountability is also important. And then you go into the provisions for independence. The provisions have to do with the term of office, right? And also provisions for dismissal. Right? The governor cannot be dismissed unless there is a very serious reason that needs to be specified in the law. Because if it's not specified in the law, then the government can say, oh yeah, he's not done this or he hasn't done that. And look at, for example, the recent dismissal of the Turkish central bank governor by the president of Turkey, Erdogan. So, you know, he was dismissed because he wasn't lowering interest rates.
Is that valid reason?
No, absolutely not.
Definitely not.
It actually scares investors from the country because it shows that the central bank is no longer independent.
No,
he was standing up to the government, but then he was sacked because he was just
not taking order.
He was, and that's a bad central bank. The central bank that takes orders, it will survive in the short term, but then the problems for the country will brew and brew. And eventually, it would be, you know, they will face some big problem, either crisis or an unsustainable bubble, or they will need to be bailed out by the IMF. It is all quite likely because central bank independence protects basically the economy from this.
Indeed.
So going back to the law, the provisions should basically make sure that the governor cannot be removed. But I would go further. From my experience, I would also create provisions for the board of the central bank, not just the governor, the deputy governors.
Yes, yeah.
For example, in Europe, we think we have very strong safeguards for central bank independence, but they only apply to the governors and the members of the governing council of the European Central Bank. Deputy governors are not protected in the same way, and other members of the governing board of central banks are not. So there are sort of improvements that could be made.
Yes,
that's one of the things I talk about in my new book, which is called Central Bank Independence and the Future of the Euro.
That's certainly a very important issue to look into. I think this is really interesting, such interesting insight from someone being actually in the middle of the play. It's not something that normal outsider would be aware of. And when we read the literature, it's those standard determinants or factors we look at, but those non-quantitative, let's say, side of the story, which has a very high relevance or importance for preventing, let's say, financial crisis is something we probably have been ignoring so far. So it's really important research and insights that we learn from you today.
Thank you.
So following that, I have a question. Considering your very special and valuable experience, both as an academic researcher, as a central bank governor, what would you say the implication or the impact of your work, looking at your own research, and if you are using your governance perspective, looking at them, what do you say the most important implications are?
The most important implications of my work, yes. I mean, I think there
are loads.
Quite a lot, obviously, but I'll try and stick to the
top 10.
To some of the top three, maybe. Well, one we already mentioned, the importance of central bank independence and with that accountability and legitimacy, because they go hand in hand. I think generally it's institutions and governance, right? And I think that needs to be always emphasized. Good governance and respect towards the institutions that govern economic relationships,
Indeed.
including rule of law,
Indeed.
for example, and regulatory quality and all that, are paramount because they're the basis, the foundations of everything.
Yes.
The foundations of financial markets.
Yeah, indeed.
The foundations of business, right? Clarity, transparency,
trust, confidence.
Trust, exactly.
Yeah.
Level playing fields, and trust in the institutions, in the rule of law, in the judiciary, in the courts, right? So all these are paramount. They're important, and you can even, as I mentioned earlier, the law is important, but if it's not implemented, so if it's not enforced, in a transparent, or it's not respected, it can't work because, and I find that, opportunist politicians who can actually, and we've seen a lot of examples everywhere now. We don't need to name names, but if they want to find a way to sort of, even with these good institutions, finding ways to
probably weakening the enforcement.
You could get bad outcomes.
Yeah,
right?
Definitely.
And I consider, for example, Brexit to be a bad outcome for the UK. and this is a country that had a long history of very good institutions, good governance, democratic accountability,
legal system,
a very good legal system, and yet we are where we are now. So yes, it's not only governance and the bank independence, but it's also respect by the political class, the political leadership of those laws and institutions. So that's my third message, and it applies, I think, to many countries.
Every country
in the world, including the United Kingdom.
Indeed. So on that note, I think we know that the research and your experience, the inspiration you give us is hugely important, and we are so honored and happy that we have you here in the studio to share with us. Thank you very much. Thank you indeed.